And India has unveiled an ambitious budget for the current fiscal year with structural reforms aimed at tackling weak economic growth and investment. Among the reforms are heavy investment in infrastructure. India will upgrade 125,000 kilometers of roads, all of that at a cost of $11.6 billion over 5 years. It will also invest $72 billion towards railway infrastructure until the year 2030. And the banking sector is also getting a boost. The Indian government will inject some $10.2 billion worth of capital into state-owned banks and sell its first sovereign bond overseas as well. India is also setting the budget deficit target of 3.3% of GDP, which now shaves off 0.1% of the 3.4% target that was set out in the interim budget. But for the world's third largest economy, valued at some $2.7 trillion, it's now aiming for a target of $3 trillion by this fiscal year, and then $5 trillion by the year 2024, not so far away. A target that some analysts are saying, well, is just too high. Neha Punya with more from Mumbai.
India's first full-time woman finance minister, Nirmala Sitharaman, was under immense pressure to announce reforms and policies that would give India's slowing economy a boost. Currently, economic growth is at a 5-year low. Rising unemployment was also a source of major concern. These macroeconomic factors are why the government has proposed liberalizing the country's foreign direct investment norms and also spending more on the creation of physical infrastructure. It has identified the aviation, animation, media and insurance industry for this, giving foreign investors a bigger role in India's giant insurance and aviation sectors. The government says it will also ease foreign direct investment restrictions in single brand retail. When it comes to infrastructure creation, an area where the government is hoping to give job creation a boost, it says it will upgrade 125,000 kilometers of roads over the next 5 years at a cost of $11 billion. It's also proposed investment in the Indian railways to the tune of $72 billion over the next decade. It's also planning to commercialize its aviation and space sectors to raise funds. There were concerns, though, over how the government planned to fund these schemes. Its revenue deficit last year was $23 billion. While it's not changed the current tax structure for the middle and lower middle classes, it has proposed a tax of 3 to 7% on the super rich. The government has also promised a substantial tax discount on affordable housing for the poor and the lower middle classes. It says it also plans to raise $14 billion this year through the disinvestment of public sector units, including Air India. It's also increased the customs duty on gold and hiked the excise taxes on fuel. To give the digital economy a push, it also plans to penalize cash withdrawals exceeding $146,000 per year with a tax of 2%. The Indian finance minister also pegged India's fiscal deficit at 3.3% as the target for this year, a bit lower than the 3.4% target set last year. Many experts are calling this an unrealistic target, at least based on the information shared by the government so far. Neha Punya, CNA, New Delhi.
India is also battling record low unemployment, which is at a 45-year high. And in today's budget, the government announced that it will invest heavily in job creation. But it failed to detail just how it will address this issue. Priyanka Kishore, lead Asia economist from Oxford Economics, told us earlier that this was no surprise.
And it was not expected to, because the BJP, which is the largest party at the center to which PM Modi belongs, pretty much set out in its campaign that it's not going to create jobs out of thin air, like, something like providing more jobs in the public sector or something like that, because that would mean more spending on revenue account, and India lacks that kind of fiscal prowess at this point of time. What it did say was that it would create growth, and that growth by itself would create jobs, and that is pretty much the direction that the budget is taking as well.